Hey Steve, good to see you, buddy. All right, so this is a quick session that was asked yesterday by some people to kind of walk you through how do I make those rules about being engaged or not engaged in the market. So, as a swing trader or even position trader, I'm not the first to say that. And if you're trading around for some time, you certainly notice that there's a few really good window of opportunities in the market each year. So the goal is really to nail down those windows and kind of step back the rest of the time. Um, Simply wait, or what you like to do, right? You can play it short, you can just sit out. But yeah, the goal is to go heavy, go aggressive into those windows of opportunity, and the rest of the time just take it easy. Don't draw on too much because obviously the next window of opportunity you want to be near your all-time high equity curve. You want to push as fast as you can to a new high and not be in a 10, 20, or even worse, 30% drawdown. Because in that case, you have to fight back uh, out of that hole. Psychologically, it will be hard to get aggressive when the opportunity arises because you will be fearful and you will doubt, not wanting to draw down even much. So this is really important to stop quickly the bleeding. So if we take like last week, for example, selling came fast. Uh, I personally took a hit when that market broke down. I took, I think it was a 3.5 or almost 4% easy hit. But since then, I didn't trade at all. So I'm still in a small drawdown, and when the opportunity will come back, it will be time to be aggressive and push to a new high right away. So that's what I will try to explain in this session. How do I use my tools to determine when it's time to be in the market, when it's time to step back, when it's time to be aggressive, or just be defensive or a bit more short term. So let's go into it. So obviously, uh, pretty much everybody knows about it. I'm using TradersLab, which is the application that we've built based on my tools at the start. So everything that is market related, market template, market model, that's the tools that I've been building for years. And with Matt, we've created Traders Lab, which integrate those indicators. That's not rocket science, but we've been able to package those all at the same place within one dashboard, and build a model with it. All right, so the foundation of everything for me is based on price, breadth, and momentum. So that's the three main components of the market, in my opinion. And that's why those tools were created from the start. So if you take the Qs, for example, or the SPY, the problem with those indices is that they're heavily weighted towards mega caps. So they're not really giving the real feedback of what's happening beneath the surface in the broad market. Um, because a large weight, I think it's like 30 to 50% of those are weighted towards the Mag 7. So everything that is happening outside of those names is not reflected as much in the price action of the Qs and of the SPY. So the idea is to use breadth. So what's happening in the broad market? Because at the end, I'm not trading only Meta. I'm not trading only Nvidia or Netflix, etc., etc. So I want to know exactly what is happening for my basket of stocks, what I trade. That's what I want to know. So there's some indices, some ETFs like the QQQE, like the RSP for the S&P 500, that are equal weight. So what it means is you take the S&P 500, the 500-ish components, and they all have the same weight in the indices. So that's very important to have a clear picture of the market, of the broad market, and what's really happening. Um, so that's what you find right here. That's the price action chart of the equal weight indices, and then you have um, for different markets. So you have the S&P 500, you have the Nasdaq, the Russell, and the NYSE, which is kind of the broad market overall. So what I use is mainly the the Nasdaq. Why? Because I tend to trade a lot of technology stock, growth stock, a bit mid to large cap. So that's what represent the best, the basket of what I'm trading. So if you are really focused on small caps, micro caps, these kind of stocks, so you can use the IWM Russell 2000. That should give you a better representation of your basket of stocks. So always try to get the best reflection of what you trade. That will give you the best signals to follow. All right, so the first step, like I said, for me is price action, being on the right side of the trend. Uh, and maybe I'll do a little, how do you say that in English? Kind of another subject, right? Uh, I think that what's really important to stay on the right side of the market is um, to be more of a trend follower. Um, I think that a lot of people might get hurt uh, when the market is trending down, for example, and you try to pick the bottom each time the market reverse. So I really like, and I think that's what gave me success in the market, is when a trend starts, I assume that this trend will continue. A counter trend move. So let's say that we trend below all moving averages and we have one strong bounce. Uh, I don't treat that as a new uptrend. I will wait for the signs that I will explain later for that market to turn uh, before considering that we have a new uptrend. And that's very important because if you try to buy each bounce And the market is really in a strong downtrend and even a sell off or a correction. We never know how far it could go. And to be honest, you can buy the dip in an uptrend for a year, for 2 year, and it always works. And you'll make a lot of money. But the one time that the market will sell off, that the market will go into correction, that's the time that you will lose all the profits that you've made buying the dip in the last year. You can seriously get hurt, both financially and mentally. So yeah, always assume that the trend that is starting will continue until that trend is reversed. Okay, so what do I use? So, like I said, the price. So, I like to use moving averages, the 10, the 21, the 50. And when the price action, so when the price is below those moving averages, uh, I assume that the trend will continue until we reclaim those moving averages, or at least we consolidate and uh, build some nice tight action, a higher low before a breakout of those moving averages. But when we start to trend below the 50, when we start to trend below the 21, that's really when you start to uh, want to have your focus on the short side and rally into moving averages or short opportunities and and extensions are an opportunity to take profits. All right, the other thing, and that's really my main tool, uh, following the price action, is really breadth. So I'm using two things: the McClellan summation and oscillator, which represent the advances and declines of a specific sector or market. Uh, so the oscillator will represent the balance of advances and declines over a certain short-term period. Uh, and the summation is the summation of the oscillator. So when the McClellan summation starts to trend, it means that over a short period of time, the tendency and the trend is to an expanding breadth market. When it starts to trend down, it means that overall imbalance, there's more decliners than there is having advancers in this market. So you can assume that when the McClellan summations start to trend down, and especially the golden line that you see right here is the 10 moving average. So it's kind of a signal to confirm a trend. So when you start to trend below that 10 moving average, and you even see the 10 moving average starting to flip down and trend as well, that's really when you want to say, okay, the market is in downtrend. Overall, the broader action is contracting, and you want to either sit out or be short side focused. Uh, okay, so you can use, so that's how I use the summation index. So when it starts to trend down, I'm mostly setting out to all new exposure. Um, and when it start to hook back up, that's when I try to look for new long exposure. So pretty simple. Um, if you keep that simple as that, you will do well. What I will explain now is kind of advanced technique. So trying to be a bit ahead of the trend, trying to anticipate a bit those turn. Um, so if we take, for example, um, the November December period, right? And if we look at the McClellan oscillator, so you can look for extremes as well. So breadth is one thing, the trend is one thing, but if you see constructive action with extreme readings, that's when you can try to position early in a trend. So late last year in December, the market was selling off. Uh, we made that extreme oversold reading on the McClellan oscillator. Uh, so you start to take notice. In early January, so we flipped back up. We had a very small 1 day hook up on the McClellan summation, but then we had a second leg down. And on that second leg down, what is very interesting is that divergence in the McClellan oscillator. So instead of making a new low, we still made an oversold rating, but it was higher low. So what it means is, and it's let's put them in line so you see clearly like that. So that low was made, and we started to look constructive on that low. So when you see a higher low on the oscillator and you start to flip back up on the summation, that's when I engage back long in the market, pretty aggressive, because we had quite the run on the summation index. So pretty good market correction or pullback. And everything was starting to hook back up with a divergence. Um, so yeah, that's what you can look for, trying to anticipate a bit. And the other thing is the breadth extension. So I'm using the breadth extension to know how many stocks are above their moving averages. And I use a combination of short term, medium term, and long term. So short term, I use the stocks above their 10 moving average. Intermediate or midterm, I use the stocks above their 50 moving average. And long term, I use the stocks above their 200 moving average. And for that, I really use extremes as well. So just like the oscillator, I use for extreme readings, just like we had late last year in December. So you normally see the first leg down, you bring the market being short term oversold with the stocks above their 10 moving average, hitting set or 7 or 8% mid December. But both the intermediate term to long term breadth was still pretty elevated. So we had that counter trend rally. Let's take, and I don't have my moving averages on my chart, but we were trending below moving averages. Uh, mid December right here, we had that counter trend rally. Uh, we went right into the declining 21 moving average. Selling came back in the market. We sold off again, another leg down. We retested those lows. Short term oversold, reaction rally once again, and notice we made a higher high on the breadth as well. While the price was rejected in the 21 moving average, probably the 50 moving average as well, rejected into prior structure, and then the market sold off again to a new low, but that's the same thing as the oscillator. We have that positive divergence right here once again. We made a higher low. The uh, intermediate term breadth, so the stocks above their 50 moving average, was for the first time oversold as well. So with that short term divergence, the midterm oversold rating that finally came in, and the price undercutting that structure um, right here. So we made a new low, came right back up, uh, hook up from both the short term and midterm breadth. Uh, that was my buy signal right here. That's when I engage. Because of those short term, midterm hookup from oversold area, and because of that positive divergence after a pretty sustained selling in the past few weeks. So you never know, right? We could have rally from here, retested the 50 moving average, and flush back down once again because the market might have need to correct and for longer and break that long-term breadth into oversold as well. So this is very fractal. When you see that signal, you engage because you know that the odds and the probabilities of having a good rally are high, but you just don't know uh, if the market will have to correct longer or not. All you know is when you start to open exposure, you gain traction. Uh, Indices are starting to break higher of moving averages. We're making a higher low structures. The market is supported again when we retest the now rising 21 moving average. The 10 is flipping above the 21, etc., etc. You start to pile up those positive signals, you gain traction, etc., etc. So I just want to emphasize this. When you nail down that low because it's constructive, you don't know if we will rally and crash. You just go ahead, open exposure because the market, the selling is exhausted, and you build exposure into that, and you trim it into strength to to protect your downside, to reduce your open rate, etc., etc. But it's really important. You just don't know how the market will react. Will we make a new high? Will the market roll over and make a new low? I'm not in the prediction business. I just execute on those signals. If my positions are gaining traction, I push even more. If they stop me out and the market roll over, then it's my signal to step back and go on the sidelines once again. All right. Uh, so price action, Brett, more on the trend side with the summation index, uh, and the anticipation part with the McClellan oscillator, uh, Brett extension, looking for short term, midterm oversold readings with a hookup as a confirmation, um, and looking for those positive divergence playing out later in the downtrend to engage back on the long side. But, and I think that that was the goal of that session as well, uh, how to know how to sit out. It's really by trusting those indicators. So when you see price breaking down from the 21 moving average, when you see the 10 flipping below the 21 moving average, like I said at the start, you just assume that a new downtrend has started and you go with it. First, you get stopped out of your position. That's some very good feedback. But then when price start breaking down on the indices as well, you just stop trying to buy new things. And when you were already in an uptrend on the McClellan summation. Um, Pretty like a sustained run. You can expect that things won't just continue higher, being already pretty stretched. So you assume that this down momentum will carry on. So when you see that summation flipping down, you say to yourself, okay, I will wait for things to play out. I will be patient. I won't try to buy every bounce, every 1 day bounce, and I will be patient. So, why I was patient last week and this week is because of that cluster of overbought, almost overbought breadth extension as well. Uh, just like I explained how I engage long on the buy side, that's the same thing on the short or setting out side. Uh, we had that buy signal. Uh, Short term breadth got overbought pretty fast. Uh, we went down. We consolidated for a few weeks. That was the chop uh, that we all felt, right? Multiple days and weeks of chop. Uh, then we were building that higher lows structures. So we tried to rally. But when you see that breadth breaking down that structure, both short term, mid term, and long term, I'm just saying to myself, okay, wait. The market went sideways, consolidated, and tried to go higher into overbought once again, but failed. And instead of just continuing to go sideways like that, it was breaking down that structure uh, on 3 time frame. And that's when you start to really trust those is when you wait for those oversold signal in between. That's when you develop that sit out power because you're just saying to yourself, okay, price broke below all moving averages. The summation index started to downtrend. It flipped below the 10 moving average. The 10 moving average shortened started to flip down as well. And we're not even yet oversold, not even on the short term, and even more on the intermediate term. Forget about the long term. We just don't know, like this one, if we'll have an oversold long term because it's been 2 years that the stocks above the 200 moving average went oversold. That happened in November uh, 2022 at the end of that bear market. That's really when uh, those big moves happen when you see that long-term breadth hitting those oversold ratings. But waiting for that at least short-term breadth to be in the tens, 5 to 15%, is really kind of the sweet spot to wait until it happens. Uh, and if we have just a tap like that, when you see a lot of destruction in the market and we're still below all moving averages, I honestly consider that as a counter trend rally. Expect to see just like this one. I expect a counter trend rally, retest maybe a neutral area of the 40-50% of the stocks above their 10 moving average, and a second leg down to bring that midterm breadth uh, near or at oversold levels. So yeah, until that happens, I know what I want to see. Until that happens, I am patient to not engage back. And let me add something very important. you and I'm not saying that I'm right and everyone else is wrong, but for myself, it's really market first. Um, you will always have good setups. You will always not try, but you will find reasons to engage back. Uh, Tesla is at the 200-day moving average. Oh, Tesla is at 2023 key support area. Uh, so yeah, you will always find a reason or a setup or something to do on the long side if you search long or hard enough. So for me, what I found to be best is to have those tools built in. I have my model. I have the signals that I really know uh, and know very well. And this is the first step in my system. If the market is not there, if breadth is contracting, I found it best to just not look at any long opportunity at all. Uh, Even if there's setups, right? And it's hard. I struggled with that for a long time, and still do, uh, especially having to, and it's me, right? That's mental. That's my problem. Uh, but having prime trading and having that sense to provide opportunities to the community. And like I said, it's in my head. It's wrong. It's not true. Uh, but I feel that need, and it's uh, it's creating that problem that you start to look for every second and second tier opportunity to engage back long when you know you shouldn't be because the market is bad. And what happens when the market is bad? Most setups, even the best ones, will fail. And if they don't fail, they will most likely chop you and just go nowhere. And eventually, even if they go a bit higher, uh, they will probably hit some resistance and roll back down and eventually stop you out. If the market is in a downtrend and breadth is contracting. So yeah, that's really what I'm looking for. Uh, Price trend, breadth trend, and breadth extension for trying to know how far on the upside and how far on the downside a move can go. So I think I covered everything. Just to okay, that is broken. We'll try to work on that. But yeah, keep in mind that we have those built-in model in TradersLab as well. So when you see pullback, uh, that's built into my price action rules, into my breadth rules, and when you have the McClellan summation flip back down, when you have price breaking down the 21 moving average, that's when you see that pullback model appearing, and that's when I want to not 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 take any new long trades and simply go on the sidelines and wait for the market to confirm a new uptrend. All right, guys, that's pretty much it for what I'm looking for setting out. I don't know if there's any question. Just give me 1 sec. Uh, I have kids around in the house. I'll just close my doors because they're playing hockey as good Canadian kids. So just give me one sec. All right, guys. Sorry, I'm back. Uh, yeah. So everything clear? I know there's a lot. Uh, I know this is quite personal rules, but the important at the end is not to use the same rules that I have. It's really to use your own tools, indicators that you backtest, that you have conviction with, and build rules around that. And if you can do that over time, over each cycle, you'll start to reinforce those and tweak them as you go. So you can use the MACD, you can use whatever you want. So let's just put on paper some rules with it. Um, and each cycle you start to look at, okay, I took a hit. Um, I am taking way too losses right now. Oh wait, my signal that my rules that I have put on paper uh, should have put me on the sidelines. I should have taken that trade. So, okay, next cycles, I will make sure to follow that rule. So each cycle, you will build conviction into what you're building, and over time, you will start to add some things. You will add maybe price action. You will add, like I do with the breadth extensions. You'll start to notice that when XYZ is getting oversold, that's normally when the market will revert and start a new uptrend, etc., etc. So, like I said, build your own rules, but it's very important to put them on papers. So each time, each cycle, if you do mistakes, if you take some losses, you can go back to those rules, reinforce them, and work on them as you evolve and improve as a trader. Is there any questions? Was it clear? You can use the chat
Hey,
as well.
I just placed my question.
Sorry, I'm not understanding, hearing you
So,
well.
yeah, so how do we plan to trail the stock, right? Like in 2024, we wanted to hold it for longer, like, trail the key moving average. But this year is like take quick profit. So, do you want to make any changes on that yet, or you want to see more?
Well, that's two different things.
Yeah.
So what I explain is um, really to protect yourself when the market is in a downtrend, right? Um, and and 2024, like you said about individual stocks, but first the price on the indices was in a strong uptrend. Intermediate and long-term uptrend, right? So what we saw was mainly short-term dip into moving averages that were bought, and the moves continued. So that's two different things because what I explained, and let me go back.
Yes, actually, it's not related to the current explanation that you did.
No, no,
I
exactly. So,
understand.
but yes and no because when you start to see the McClellan summation flipping back down, like I explained, when breadth is contracting, and you get that pullback, right? Uh, you want to hold on to new exposure, uh, even if it's a dip, even if it's a small pullback into moving averages. You still want to see uh, price coming in. You want to see the McClellan summation flipping back up. You want to see at least short-term breadth being oversold in order to bring back exposure, start to look for new exposure, uh, even when you hold for longer. And the other part, which is very important, is rules about individual stocks, about your positions. Uh, when you're looking to hold for longer moves, you use longer term moving averages. So the changes that I've made are using the 21 and the 50 moving average. So when you start to hit overbought levels, that's when you trim into strength. When you start to flip back down, you don't buy any new stuffs. It doesn't mean to sell all your positions, but you took profit into strength when the market was overbought. When the breadth is shifting back down, when it's contracting, you have less exposure. You're not 100% and 150% in margin. So you have maybe, I don't know, 60, 50, 40% exposure. You're holding your cores of your positions as long as they hold the 50 moving average. And when short term breadth is getting oversold, and obviously you have constructive setups in the market, then you can start to add back exposure, add back to your cores new positions as well, and you build back your exposure, even getting aggressive if it's only a dip in a longer uptrend. Does it answer your questions?
Yes.
Perfect. Was it the same question that you asked in the chat as well?
Yeah, it
Oh,
is the same question. I
oh,
think
okay.
there is one more question. How do
Okay.
you use is somebody else? Yeah, plus minus 4% maybe.
Yeah, the momentum readings, right?
Yeah.
Um, I use I use it, but it's very secondary indicator for me. Um, because those ratio can be quite distorted by an imbalance from one side or the other. And what I found is they are good for short term bounce. So, like right now, we have short term oversold. We are oversold on the 5 day ratio as well. Um, but I didn't find as big of an edge as I did with the breath extension. So yeah, I have him there. When I see kind of a confirmation between the two, it had convictions for me, but it's not a main indicator. For me, really, the main indicators are price action with the moving averages, McClellan, both the summation and oscillator, and the breadth extensions. My pleasure. All right. Any other questions? Oh man, I think it's all's in the wall as well. They're playing pretty rough. All right. Um, any other questions? Otherwise, I will close the session. I hope it was clear. That's pretty much the same stuff that I share each night in the daily report, in the situational awareness channel. So I try to explain, and I will do more of those. I will try to explain each morning uh, with those rules, right? Price action, breadth, and breadth extension. Uh, what is the plan for the day? Do I look to uh, increase exposure, engage aggressively, hold back on any new long, or sell exposure, trim into strength, etc., etc. With those tools, that pretty much give me my game plan personally. So, trying to make it clear for everyone how I use them and how they could be used by you as well. Yeah, pleasure. I think it's important to have a set of tools that you weigh differently. So you have really your first tier indicators that all your decisions are based off. And as you work with more, uh, you just have to make sure that it's not creating noise, that they all work together. And so when you see confluence of those indicators, it will add um, conviction into the market setup. But just be careful to not having too much indicators. Otherwise, you get uh, paralyzes by analysis, right? You start to track too many things. Some indicators will um, contradict others, and yeah, you'll always find a reason for not trusting an indicator. So very important to uh, I have three, right, with different time frame, but really trying to narrow down your indicators to a small set. And yeah, for me, this is price, breadth, and breadth extension. All right. So I hope you guys enjoyed the session. Don't hesitate. If you have any more questions, you can ask them in the question and answers channel, the Alex section of this Discord. Um, and yeah, enjoy your day, enjoy your weekend, and let's be patient about this market. We just don't know where this market will sell off. I think it's pretty clear that right now the trend is down. We do have some short-term breadth extension, so reaction bounce possible. Um, but yeah, the midterm, long-term picture is still contracting. So for me, it's still a sit-out market. All right, take care, everyone. Have a good day. Bye bye.